Welcome to the Deep Dive. Today we are focusing all our attention on Vishay Intertechnology, or VSH, right after their Q3 2025 earnings call.
Yeah, we've gone through the transcripts, the decks, all the analyst notes.
And our mission, as always, is to cut through that noise and give you the shortcut to understanding what's really happening with this key U.S. components company.
And VSH gave us a genuinely complicated picture this quarter. It was a classic scenario, actually.
How so?
Well, they delivered what looked like a healthy top-line beat, but that good news was, almost instantly wiped out by all the concern over their margins.
And the guidance. The guidance was incredibly cautious.
Exactly. It was the definition of a mixed result, and the market, it did not wait. The stock was pushed down almost 5% on the day.
Okay, so let's get right into it. Let's start with those headline numbers that VSH reported.
Go for it.
Revenue came in at $791 million. And
Yeah.
It's a solid beat, right? It landed comfortably above what analysts were expecting.
Yeah, by about 4 to 12 million, depending on whose numbers you were looking at.
And what's more important to me is the trajectory. Revenue was up 4% from last quarter.
Sequentially, yeah. And 7.5% year over year. The top line is definitely moving in the right direction.
But the bottom line was where it got tricky.
So tricky. Adjusted EPS landed at 4 cents. That was, fine. Right in line with the high end of the models.
But, and this is a big but, the GAAP EPS, that was a net loss.
A net loss of 6 cents per share.
So that's a 10-cent swing.
Yeah.
For our listeners, what's driving that massive gap? Is it operational or is it something else?
It's mostly tied to their strategy. You're seeing non-cash restructuring charges, asset write-downs, all linked to these big facility optimizations they're doing.
Okay, so it's accounting stuff, but it points to real-world pain.
It absolutely does. It reinforces this whole narrative that they are in the middle of a very painful, very expensive operational cleanup.
And that structural pain brings us right to the margins. The market just zoomed past the revenue beat and went straight for the gross margin.
Which was 19.5% flat.
That feels dangerously thin for a company that's trying to be a high-tech component supplier.
It is thin. And management knew they had to get in front of it. They were very quick to point out that this 19.5% number included a huge quantifiable negative hit.
This is the Newport facility drag, right?
Exactly. About 150 basis points of drag just from optimizing and ramping up that Newport facility.
Wait a minute. Asking the market to just ignore 150 basis points of cost? That seems like a huge ask. Is this really a temporary thing?
That is the multi-million-dollar question, isn't it? That's what determines the stock's future. Management is adamant that it's a transitory cost.
So if you strip that out, what does the underlying margin look like?
They're saying it's closer to 21%, so they're basically staking their credibility on fixing this Newport drag.
And Newport wasn't even the only headwind.
Not at all. They also cited elevated metals, prices, gold, palladium, silver, the copper tariff, some negative FX impact.
So all told.
Combined, those were another 50-plus basis points of drag. They are running incredibly hard just to stay flat.
Okay, let's shift over to demand. What's the order book telling us? Because if margins are struggling, they need strong volume to pull them through.
Well, the first data point caused a little bit of anxiety. The overall book-to-bill ratio dipped to 0.97.
Just below 1, so they shipped more than they booked.
Right. And crucially, this was the first time that ratio fell below 1 all year. That usually signals some caution ahead.
But there's a little more to that story, isn't there?
There is. Orders were still up a very healthy 19% year over year, and management was really quick to highlight that the October run rate for book-to-bill had already bounced back.
Bounced back to what?
Sharply, up to 1.15. So it suggests that dip was maybe just a blip, some timing issue.
And that jump back to 1.15, it reinforces this idea that customer behavior is just. It's all short-term now.
Completely. Over 50% of their Asia orders are short-term requests. We're talking pull-ins, expedites. Customers are basically showing up saying, I need this now.
And because of all their spending, VSH can now actually service those requests.
They can, which allows them to pick up share. They can be the responsive corner shop instead of some massive producer with 6-month lead times.
But that capacity costs money. Which brings us to cash flow. Free cash flow for the quarter was negative $24 million.
All because of CapEx. Heavy capital expenditures hitting $52 million.
And most of that was for expansion projects, right?
43 million of it, yep. Their capital intensity is high, running at like 10.8% on a trailing 12-month basis.
So they're sacrificing cash flow today for capability tomorrow.
It's a strategic choice. Management even said to expect negative free cash flow for the full year. This is all about prioritizing their long-term growth plan, what they call Vishay 3.0.
Let's pivot to that plan then. Vishay 3.0 is all about positioning them as an enabler of megatrends. Where are we actually seeing that show up in the revenue?
We saw definite proof points in Q3. Take automotive. It increased a very respectable 7% quarter over quarter.
And then this isn't just cyclical noise, it's design wins.
Right. Driven by volume in the Americas and Europe, design activity across all powertrains, gas, hybrid, EV. They're getting new site approvals in the UK and Mexico. That feels sustainable.
And then there's the industrial and smart grid stuff, which is where it gets really sticky.
Exactly. The segment is being driven by high voltage DC power capacitors for huge smart grid projects in Europe and Asia.
And these are not small orders.
Not at all. They said orders for these projects are already placed well into 2026. That gives them incredible visibility, which is, a nice counterbalance to the short cycle business.
And of course, you can't have an earnings call without talking to AI.
Of course not. But VSH actually showed increasing order flow tied to new AI servers. The crucial part here is that they're expanding their content.
It's not just their traditional MOSFETs and ICs anymore.
No. They are now supplying the entire power chain. Diodes, capacitors, inductors, resistors. They're increasing their dollar content per server, which validates their entire strategy.
Plus, we're finally seeing a pickup in aerospace and defense.
That's right. The funding is finally flowing to the big military contractors, and VSH is seeing orders pick up for their really niche, high-reliability products.
Space-grade stuff.
Space-grade planar transformers, DLA-approved capacitors, high-margin business when you can get it.
Okay, and finally, they had to address the elephant in the room, the geopolitical situation with Nexperia. Are they seeing a real benefit from those export restrictions?
They were very, very cautious. And, that's the smart play. They confirmed they are talking to automotive OEMs and tier ones, helping them prevent line downs.
But they wouldn't put a number on it.
No. They called the situation dynamic and said it was too early. They don't want the market thinking their success is just built on a competitor's problems.
So if you tie this all back to why the market is so skeptical, it's like the market is saying, okay, we believe your growth story.
But we do not believe your margin story yet.
Exactly. The whole focus for the near term is margin repair. Management is putting a huge marker down on getting that Newport facility to be margin neutral by the end of Q1 2026.
That is their credibility test. If they hit that target, the narrative can change.
And the Q4 guidance just hammers that caution home. Revenue guided flat, gross margin guided flat at 19.5%.
With the full Newport drag continuing, so no relief in sight for Q4.
And the market's reaction, that nearly 5% drop, it makes perfect sense when you look at how much VSH has underperformed its peers.
The underperformance is just stark. Over the last year, VSH is down 14%. The SOXX semiconductor ETF is up over 18.5%.
Wow.
It's a massive gap. If you bet on the sector, you won big. If you bet on Vishay specifically, you lost significant ground.
So the market is pricing this like a low-quality cyclical commodity supplier.
Not like an enabler of megatrends. They are waiting for hard proof of margin repair before they'll pay up for that story.
Which brings us to our final segment of the deep dive.
This is not financial advice. We're not telling you to buy or sell anything. But if we were pitching an asymmetric trade idea based purely on this earnings call.
The thesis is pretty simple. It's built entirely on this idea of a fixable problem. The market has priced VSH like it's structurally broken.
Right, reflecting that known quantified drag from Newport, that 150 to 175 basis points, and the soft guidance.
The question is, if they actually fix it, how fast does the stock re-rate?
So our trade idea would be a pair trade. You want to isolate the risk entirely to their operational execution. You go long VSH common stock, and at the same time, you take a short position in a broad index of, say, analog and power laggards.
So the rationale is tight. If management hits their goal, if Newport becomes margin neutral by the end of Q1 2026, that is an immediate 150-plus basis points of gross margin expansion.
Right. And that profit, combined with volume leverage from the growth they're expecting, should trigger a pretty rapid multiple re-rating. It would close that huge valuation gap to the SOXX.
And the short position protects you if the whole semi-sector rolls over for some macro reason.
Exactly. It makes the trade purely about whether you believe management can deliver on the Newport fix. The market is betting they can't. This trade bets they can.
So to summarize our deep dive today, VSH is absolutely executing its long-term growth strategy. They're winning in AI, automotive, smart grid.
The entire company is squarely focused on proving margin stability over the next 2 quarters. The path to higher profits runs directly and very painfully through that Newport facility.
And that leaves you, the listener, with the final question.
Is the current stock price discounting a fixable temporary margin problem that's going to evaporate in 6 months? Or is VSH structurally capped at lower profitability forever? That's the whole game right there.
Thank you for taking this deep dive with us today.
We appreciate your time.